All right, hello and welcome back to the Broken Business Models podcast. We're your hosts, Ryan and James. And before we get into today's podcast, just a quick disclaimer how we start each of these. Nothing in this video or any of your other materials should be taken as investing advice. We frequently talk about things that are high risk in the investing and trading world, so make sure you do your own work and always consult a professional before making any investment decision. So with that being said, the topic of today's video is going to be a stock called Destiny Tech 100 Inc. that has been extremely volatile and getting a lot of investor attention in the past couple of weeks that it's been trading. One of the reasons that it has received so much hype is because this particular stock is one of the only ways, if not the only way, for retail investors like you and me to be able to invest in private companies such as SpaceX and OpenAI. However, with that, there are a lot of dangers and potential pitfalls that a lot of retail investors may not be aware of, which is what we're going to be talking about in today's podcast. Before we get into the topic of today's video, though, just a quick reminder about our website that we have called differentiatedanalytics.com. We're going to link a video in the description below that gives a brief description and summary of all the different things that you get if you choose to subscribe to this website. So if it is something that you are interested in, make sure you use the coupon code WSM50 for 50% off, which will bring your monthly cost down to $10 per month. And subscribing will also give you access to our private Discord server in which we talk about stocks, and you can also make requests for video topics on this channel and on our main channel. So with that being said, I'll kick it over to you, James, to explain what is this particular stock and why it's so interesting.
Yeah, so this Destiny Tech 100, the ticker symbol DXYZ, it is a closed-ended fund that invests in private companies. So you can think of it kind of like a venture capital fund, but it's listed on I think the New York Stock Exchange and Nasdaq. So it is accessible to retail investors. Anybody can buy shares of DXYZ, and they own a lot of well-known startups. Their single biggest holding is SpaceX, Elon Musk's space company, which represents 35% of their portfolio. They have another space company called Axiom Space, Boom Supersonic, which is a company that's trying to develop supersonic jets. Think of it as like the Concorde 2.0. They own a stake in Epic Games, Brex, which is a digital bank, Superhuman, which is a software company, and OpenAI, which is obviously the company behind ChatGPT. So if you look at DXYZ's portfolio, they have some real, heavy hitters, something that a lot of investors have heard of, like SpaceX, especially SpaceX, Epic Games, and OpenAI. These are companies that a lot of investors know about, and perhaps they would want to invest in these companies if they had a chance. But because they're private, there's really no way to invest in them until now. You can buy shares of DXYZ, and then you'll indirectly be investing in these companies because they're part of their portfolio. So that's sort of the main selling point of why Destiny Tech 100 listed on the stock exchange, so that retail investors can participate in these. So for any closed-ended fund like this, you have to look at the net asset value and the number of shares to get the net asset value per share. So all of their stakes in these startups, based on the current private market valuations, are worth $52.6 million. And DXYZ has 10.9 million shares outstanding. And then that gives them a net asset value per share of $4.84. And if you look back at the stock price, is currently $29. So it's selling at almost six times of its net asset value. So if you think about it as comparing the stock price to the actual value of what it owns, you're buying a $5 of value for $29. So we're going to go through a little bit in this video. We're going to go through a little bit deeper, looking at some of their portfolio companies. And then we'll try to see why is the stock trading at such a massive premium to net asset value, and can this ever be justified? So one thing is, while DXYZ only listed on the stock market a couple weeks ago, it has been in the fund itself has existed long before that, since like the first half of 2022. So it has more than a year of history of the fund from before it went public. And this black line here is the performance of Destiny Tech's net asset value, and the blue line is comparing to the NASDAQ composite index. And these the net asset value is based on the private market valuations. And Destiny Tech 100, they have an independent valuation auditor, which every quarter or so will measure the valuation of the startups that they own stakes in. And this can be based on things like previous funding rounds, or the financial performance of the company, or whatever. So it's not perfect. There can always be controversy in how on how private companies are valued, but we have to go off of their numbers of their own NAV calculations, because that's basically all the information we have. And now if we look at, the Destiny Tech, its performance since inception, this is a chart provided by Destiny Tech 100 itself. It has not been good. So from May of 2022 through December of 2023, their net asset value has declined by almost 40%. While during that same period, the NASDAQ has increased by more than 30%. So it's underperformed the NASDAQ by almost 70%, which is, pretty horrible returns. And this, might be surprising to a lot of people. A lot of people have this idea that venture capital is this really great place to invest, because you're investing in all these super innovative tech startups like SpaceX and OpenAI and whatever, and therefore you should have very high returns. But here we can see, even in a situation where their technology stocks did very well, Destiny Tech 100's private portfolio did horribly. So let's dig in a little deeper into what DXYZ's portfolio companies are. So currently they have 23 investments. And of the 23 investments, only 3 of them are in the green since they invested. All of the other ones are either break even or have suffered losses, and some of them have suffered very significant losses. And so the only ones they've made money on are SpaceX, Boom Technology, which is that's the one that's making trying to make the supersonic airplane, and Axiom Space. That's a space company that's trying to make a private space station. And then there's a couple like Jeeves and OpenAI. I think these were very recent investments, so they haven't changed at all since they made the investment. But I think it's worth looking at, some of their disasters, some of the ones that have had very poor returns, and seeing, what happened there. So their single worst investment has been a company called Bolt Financial, and they have suffered a 93% loss on net asset value since they made that investment. So what is Bolt Financial? So Bolt Financial is a fintech company that makes some sort of software to help like e-commerce companies do online checkout. And in March of 2022, DXYZ invested $2 million into Bolt Financial. 2 months later, the New York Times releases this article accusing Bolt of misleading investors. So this is the article from the New York Times. Bolt built $11 billion payment business on inflated metrics and eager investors. And this guy here meditating is or at the time was the CEO of Bolt Financial. He was also the co-founder of it. And maybe I'm being too judgmental, but I personally would never invest in a company whose CEO looks like this, insofar as, how he's dressed and, a general lack of seriousness in this photo op that he took. But here's, a couple select quotes about Balt's Financial from this New York Times article. Balt often overstated its technological capabilities and misrepresented the number of merchants using its service. One of Balt's biggest customers, Authentic Brands Group, is suing the company for having utterly failed to deliver on the technological capabilities that it held itself out as possessing. Employees were encouraged to approve transactions even when they looked risky, which contributed to large losses for Balt, former employees said. But the approach kept merchants on the platform, which was important because Balt used its merchant count as a key metric in fundraising. So basically, what the article is saying is that Balt exaggerated their capabilities both to investors and customers to try to make it look like they're better than they actually are as far as their technological capabilities. And they would also focus on growth at all costs. So they had one of their products is a software that helps in a system that helps to prevent fraudulent checkouts or fraudulent transactions for e-commerce. And apparently it wasn't doing that well. Their product didn't work that well, and their employees were approving a bunch of transactions that looked like they were risky. They could be fraudulent. Indeed, a lot of them were fraudulent. And then Balt, as the service provider, is liable to compensate the retailer, the customer, for all of these fraudulent transactions. But they decided to basically just do that anyway because that keeps their customers happy, and then that looks good to investors. So that's one of the big problems. You can get sort of a principal agent problem with venture capitalists and the founders of the companies, where the founders will try to, manipulate the statistics and, manipulate how they're running their business in such a way that their metrics will look good to venture capitalists, even if that leads them to make bad business decisions, which cause them to lose money. And as we can see, this is just one article from the New York Times. We don't know, how true their allegations are, but the fact that, DXYZ marked down their investment in Balt by 93%, maybe suggests that a lot of these allegations from the New York Times could be true. And this kind of goes to, a lack of due diligence on the part of DXYZ that they made an investment like this. Another example of one of their disastrous investments has been in Impossible Foods. They make fake meats. They're a competitor to Beyond Meat. And the valuation of Impossible Foods skyrocketed in like 2020, 2021 during sort of the COVID bubble. But as it turns out, fake meat most people think it tastes bad. In a lot of ways, it's less healthy than real meat, and it's usually more expensive than real meat. So very few people, not that many people actually want to eat it, and it's too expensive for a lot of people. So, Impossible Foods has kind of seen their business deteriorate, and their valuation has declined by almost 90%. We can see here that DXYZ has marked down the value of Impossible Foods by 80%. So the point of looking at a couple of these examples, looking at this chart, is showing that DXYZ's investment performance has actually been quite bad. And that kind of makes it all the more surprising that the stock is trading at such a massive premium to net asset value. Usually, maybe you would think it's the other way around. If the venture capitalist is sort of failing at finding good startups to invest in, maybe it should trade at a discount instead of a premium. So why is it trading at a premium? And then one last thing to talk about DXYZ is they charge a 2.5% per year management fee on the net asset value of the fund. So this is, regardless of what the performance of the fund is, whether it's up or down, the managers will always charge a 2.5% fee. And while 2.5% might not sound like a lot, this can really add up over time. And to show an example of this chart here, the blue line is just the S&P 500 over the past 5 years. And then the red line, or the orange line, is the same S&P 500, but I deducted a 2.5% management fee per year. And so and this is over the course of 5 years. So if you started off with $268 and waited over the course of 5 years, that would have grown to $511 with no fees. That's the blue line. You go from 268 to 511. But with fees, it would only have increased to 464. So with the after the 2.5% fee, it goes from 268 to 464. So that's 46% less by the end. And that represents about 20% of the gains that you would have experienced. You don't get because that goes to the management fee. And over a longer period of time, that the impact of the fees will actually increase, because the fact that you're paying these fees over time means that your value, your investment does not compound as fast, because that money that would have gone into compounding to grow over the long term actually ends up being eaten up by the fees. So the longer, you can see even just in this chart, earlier on, the lines are basically the same. There's not much difference. But as we go further on, the gap widens as these fees accumulate. And so the point is, a 2.5% fee per year is a very hefty fee. And because of these high fees, most closed-ended funds tend to trade at a discount to net asset value, not a premium. And I did this, there's a website called CEF Connect, which keeps track of a bunch of closed-ended funds that trade on the stock market. And I looked just at U.S. equity funds in the closed-ended funds that invest in U.S. stocks. And of them, currently, the average discount to NAV is 12.4%. So for most closed-ended funds, because people see that they have such high fees, and that decreases the expected return of it, investors don't like that, so they're not willing to pay so much for these closed-ended funds, and that causes them to trade at a discount to NAV of 12.4%. While on the other hand, DXYZ, which also charges a very large fee, is trading at a premium of like 6 times. So, this goes to show that the situation with DXYZ is very unusual, that it's trading at, such a high premium when most closed-ended funds trade at a discount. So now the main question is, given everything we just talked about, why is DXYZ trading at such an seemingly absurd premium? And I think probably the reason is, if we go back to the holdings of DXYZ, their single biggest holding at 35% of their portfolio is SpaceX. Now, SpaceX has, it's a very famous startup. A lot of people know about it. It's obviously Elon Musk's private space company. They launch rockets into space. They have their Starlink thing with the internet. So it's something that investors are very excited about, and maybe rightly so. And then people might say, yeah, this DXYZ, it trades at a huge premium, but it's my only way that I could gain access to being able to invest in SpaceX. So maybe it's worth it just because of that. Unfortunately, it's probably not going to work out that way, because SpaceX's current valuation is $180 billion. And so I did the math, and for SpaceX to single-handedly close the premium to NAV, its valuation would need to increase 14-fold to $2.5 trillion. According to TechCrunch, SpaceX generated $9 billion of revenue and $3 billion of operating profit in 2023, which is pretty minuscule compared to the $180 billion valuation, or the $2.5 trillion valuation it would need to be able to close the gap as far as the premium to NAV for DXYZ. And the reason I did this calculation is because, DXYZ's investment track record is pretty bad, as we've shown earlier. But, given that they have more than a third of their portfolio in SpaceX, many people want to buy it just for the SpaceX. But the amount for you to make money, obviously you need the value of SpaceX to increase, but you need the valuation of SpaceX to increase by 14 times to make up for the massive premium to NAV just for you to break even, right? Just for the DXYZ stock currently trades for $19. The DXYZ stock currently trades for $29. The net asset value is $5. For you to make up that $24 of difference, you would need, and you're only counting on SpaceX to do that for you, you need SpaceX to increase 14 times from its current valuation, and its current valuation is already very hefty. So it seems like a slim chance that this will ever happen. And the final consideration is whenever you're investing in anything, it's always good to know what you own. If you're going to buy shares in a company, you would want to see how well is the company doing, how much revenue are they generating, how much profits are they generating, etc. The problem with all of these private companies is because they're not publicly traded, they're not required to disclose their financial statements or anything like that. So it's very difficult to actually know how well these companies are doing. Like, for example, in the case of SpaceX, I got these revenue numbers of $9 billion and operating profit of $3 billion for 2023. Well, that's just based on one article from TechCrunch. We don't even know how reliable that is. And for a lot of these other, smaller startups, we don't have any data at all as far as how much revenue or profits they're making. And so it's very difficult to be comfortable investing in something like DXYZ when you really have very little means of knowing how well their portfolio companies are actually doing. So all of these factors taken together leads, at least in my opinion, that DXYZ is a horrible proposition for investors. I think a lot of, maybe some retail investors just see that it has a stake, that it owns SpaceX and OpenAI, and then just based on that, they invest in it. But you have to actually look at, look at the details. What is the net asset value? What is the premium that you're paying? And is it realistic that you're ever going to, make a profit on your investment when you're paying such a massive premium?
So I think one of the common arguments for private market investing is that, due to liquidity or whatever else, private market valuations can often be lower than public market valuations. And then on top of that, maybe you can make the argument that the poor track record of DXYZ's portfolio companies might be deflated due to comparisons to a couple years ago in 2020 and 2021 when there were zero interest rates. Could the gap in valuation, the premium of DXYZ's market cap versus their private market constituent companies NAV, could the gap be reconciled by just, maybe the NAV should be re-rated if you're thinking about it as publicly traded, as like public assets versus the private market valuations?
Well, for that to be the case, you would need the public market valuations to be 6 times greater than the private market valuations, which seems like a slim chance, especially when you take the fact that SpaceX, which is one of the few companies that we actually have valuation data for, $180 billion of valuation at $9 billion of revenue. So what is that? Is that like 20 times revenue? So that's by no means a cheap valuation. And then, so it's already 20 times revenue in the private markets. Plus, you have to multiply that by 6 because there's the 6 the 6x premium for DXYZ. So you're actually buying, if you are investing in DXYZ, you are indirectly investing into SpaceX at a valuation of what did I say? Of 120 times revenue. 120 times revenue. I mean, that's pretty insane. I don't really see, even for a company like SpaceX, it's hard to justify a valuation like that.
And so I guess you really have to believe that a lot of these moonshots will hit in order to make up that gap. And
Yeah.
as we've seen, like a lot of these companies are small, privately held companies for a reason compared to other like big publicly traded companies like Apple, right? It's because they're unproven, and you really
Yeah.
have to believe that a lot of them will hit, because even the biggest one, SpaceX, as you said, would not be enough.
Yeah. So I think that about wraps it up for this video. As always, if anyone has any questions or comments about DXYZ or anything else, please leave that in the comments section below. And remember to check out our website, differentiatedanalytics.com. You can get lock in 50% off with the discount code WSM50 at checkout. The link to that is in the description below, as well as the link to the video we just created, it going through and explaining all of the features that you get access to on the website. So with that being said, we will sign out and see you guys on the next one.